All right, welcome along. This is Sunday Letters podcast, newsletter, all about work, the nature and value and purpose of work, and why we do it. And connected to that question, what is work? How do we find meaningful work, and so on? Is the question of money? How do we get it? How do we get loads of it? Why am I not getting enough, and so forth? Where does it come from? So, in this episode, the latest in a series on what is money, we're talking about MMT, and we're joined today. Dimitri and I are joined by Brian Romanchuck, a native of Montreal in Quebec. You're very welcome along, Brian.
Okay, thanks. Good to be here.
Brian is an author of several books on economics and MMT. You'll find him at bondeconomics.com. Launched that in 2013. Previously worked as a senior fixed income analyst. He held a few positions, including the head of quantitative analysis for fixed income. Previously worked as a quantitative analyst at BCA Research, a Montreal-based economic financial research consultancy. So Brian is well versed in all things banking and finance, and he's got the technical knowledge, please God, to answer some of these questions that we have around money. What is it? What is MMT? Modern monetary theory, and why we should be bothered about it at all. So we're going to jump into this, and I suppose, Dimitri, you've got the first question on the list for Brian today. You want to jump into it there?
Sure. First of all, thank you, Brian, for being here today with us. And the
Thanks.
first question, actually, the basic one, like, what is money? Can you explain us?
Okay. For me, I do have a book, Abolish Money from Economic Theory. So I have some opinions about money, but I'm going to, I have complaints how money is used in economic theory, but that I'm not going to go into. The money it's important. And if you live in a monetized society, there are societies where they don't use money. I'm not an expert on them, but they would be based on gifts, obligations, and quite complex. It's not barter like people assume. People would owe each other favors, and people would keep track of who owes who what in terms of gifts. But money sort of simplifies things. You instead of keeping track of, well, this person loaned me a cup of sugar last week, you just sort of, those relations still exist, but mainly you just hand people money, and when you buy something in the store. So you monetize the economy, and that's what everyone is used to.
So is it, sorry,
And
so is it fair to say that money is just a medium of exchange? Right.
Yeah, yes. I mean, it's the sort of, well, yes and no. I mean, money, you could sort of say medium exchange, you use it to pay for things. That's sort of the way it's usually thought of. But to a certain extent, people in households, the average person, you get a bit of a biased view of how the economy works. You also have to take into account how businesses operate, and to a certain extent, and now it's quite common you'll use a credit card to pay for things. A credit card is technically not money. You go in a store, you swipe your card, tap it, and they'll give you a good or service. And it's not, they receive, they don't receive what is technically money, which I'll get to. They just get, I owe you money. It's intermediated by the credit card company. And businesses, they will also pay for, businesses rarely pay cash up front. They will do a receivable. Say, yeah, we'll pay you in 30 days. And, and so the money is quite often, it's not used to pay for goods and services. The money is used to settle debts. And that's probably, it's an important factor. And what what money then, it's not just used to pay for things, it's also a unit of measure. It's a unit, they call a unit of account. You use money to measure the size of debts. I owe you $100, and then you have to get a transfer, the equivalent of $100 to the other person. And that's how the economy sort of works. It's providing a measure for all the transactions. And sometimes you use what is technically known as money. Other times you use other instruments, which are technically not part of the money supply, but you use them to pay for goods and services. And when you look at things like for individuals, credit card payments. For businesses, you pay account receivable. In the financial markets, people use they borrow margin debt or there's other fancy ways of borrowing in fixed income markets, and they're very large. Repo, for those who've heard of it, and technically you're not using money to pay for things. So that's the thing, is that people want a nice simple model where there's a money supply. Like the ideal that everyone wants is there's a certain amount of money out there, and if you double the amount of money, the prices of everything doubles. This is the sort of model everyone has. Well, a lot of people have in the back of their mind that it's used to pay for things, and you can define money. More money means, the prices will go up. There'll be inflation. And you can get that. Like, you can redenominate a currency. This happens. You just say, like in a high inflation country, what'll quite often happen is we'll say we're just going to lop a zero or a couple zeros. We divide the old currency by 100. You issue new currency, and everything gets redenominated. And yes, of course, everything will drop by a factor. The prices of everything are supposed to drop by a factor of 100. That's sort of what people would like. That you change. It doesn't necessarily work that way for other changes in the money supply.
It's like it sounds like a stock split, Brian.
Hmm?
It sounds like a stock split.
Yeah, it's a stock split. It's the equivalent of a stock split. And of course, it's clean. And it has an effect because it helps break inflationary psychology. But effectively, yeah, it's a stock split. It doesn't really change, the value of the money. You just, you've lopped some zeros off, so it feels better again. So it feels like you've gone back to the old prices. Things that used to cost $1 went to 100. Well, they're back to $1 new again. So that does happen, but it doesn't. That's a very unusual situation, and that's where sort of money doesn't work. And I guess I'll get into. So what is, technically was money? You have a money supply measure. And this is sort of a technical definition. Economists say, what is money? And there's different sort of jurisdiction, Euro area, the US, UK, Canada. They'll have maybe slightly different, because the financial systems are different. And so they work slightly differently. The general principles are the same, but they'll be slightly different. And so they'll count them different. You have different different money supply measures for things that are really narrow, and then ones that get larger. And the narrowest definitions of money are what we could call government money, and that is
that's what we work for. That's what, when we go to work, we get paid. That's what that means.
Well, I would say yes and no, but yes, that is they provide the base. And in terms of the unit of measure, like the unit of account, the government money, like in a modern economy, it is the thing that drives everything. Is effectively everything else is converted into the equivalent of government money. And so in the euro area, it's euros. The US, United States, US dollars, Canada, Canadian dollars. You can use other things. Like in Canada, it is relatively common. People can get US dollar bank accounts. Stores will take American money. Like rest, they're, anyone facing tourists will often say, "Well, here's our exchange rate for American money." So you can use other monies inside, another country, but usually everything like legal, everything is driven by, what the government issue. And government money, there's two sort of categories. You have the banknotes, which call them banknotes issued by the government, bills. They used to be paper. Now Canada, they're all plastic coins. And those are issued usually by the central bank. And but if you look in Scotland, I believe it's still you do have private banks that issue notes that are treated as equivalent. That's sort of the way it used to be in ye old days. But in general, countries have moved. The central bank issues a currency. And the other one, the other sort of category of government money is deposits at the central bank. I'm currently working on a book on banking, and banking is an area that people also, it's not that well understood because most people aren't bankers, and so they don't think about things the way they are as banks. But if the central bank has a job, it is a bank for banks. And that's what they act as the banker for the central government, and they also act as a bank for private banks. And euro area, okay, that's more complicated because it's split up. But in other countries, it's relatively simple. That's how it works. And so, like people have deposits at the central bank, private banks leave deposits at the central bank.
Is that digital?
And
they're digital deposits, Brian, are they, or are they
yeah,
actual?
yeah, it's all well, all deposits are, well, nowadays digital. They would have been written down by hand.
Yeah.
There's nothing physical associated with them. They're purely an entry, which is how with banks, like you can have like in Canada, it's possible to have an internet bank where you'll never physically, they have no branches. You'll never physically hand cash to them. It's all done electronically. And it's the same thing. Like my bank, most of my dealings with my bank are all electronic, except when I withdraw money period, bill, so I can go to Tim Hortons, buy some coffee. And I'm Canadian, go to Tim Hortons. So the uh, but so that's an electronic, and it's the same thing. They're deposits held by private banks at the central bank, and these are also known as reserves. And so you'll hear about bank reserves, and these are bank reserves. And I don't really
This actually ties into a question you had, Dimitri, isn't it? Another question you had around bank reserves, isn't it?
Yeah, I had the question. Well, it's regarding the private banks, the fractional reserve, but I guess the situation where the bank should have a 10%
Yeah,
fractional reserve of every deposit made to the bank. So
yeah,
the question is, like, if for example, the standard story is that the guy comes into the bank and he deposits $100. So the bank should leave 10% of it as a fractional reserve, right? But what if, and then the bank loans out the rest of the 90% to the other banks or other individuals. But what if this customer returns to the bank and demands his $100 right away after the bank loaned it already? So the bank would be insolvent, or why do they keep only 10% of the amount
yes.
deposited?
Yeah, that is a core part of my banking book, which is unfortunately unpublished, that I'm working on. The reserves, if you mean, no, the 10% is very popular. It used to be 10%. It's very convenient for textbook questions. So any economic textbook, they always use a 10% reserve, because what happens is that deposits are 10 times the amount of reserves held. And so it's called the reserve multiplier story. If reserves increase by $1, you get a $10 increase in deposits. That's sort of the way it's expressed. And the belief was that the central bank could push around the amount of deposits in the economy by pushing on reserves. But what actually happens is that uh, no, it doesn't exactly. The causality is the bank has, let's say, $10 in deposits, and it will get its hands on $1. Like, it will just make sure it has $1 in reserves, and that's it. If it can't find, if it can't get meet the reserve requirement, yes, it's insolvent and it's in trouble. But the entire job of a bank, they have two main rules in the economy. One is credit risk management. They lend money, and they're supposed to lend money to people who don't default. They're supposed to be good at it, and that's one thing they're supposed to do. The other role for a bank is liquidity management. They buy and sell liquidity. People have credit lines. You say, oh, I need I need money, the ability, like in Canada, it's very typical. People would do it for, let's say, renovations. You say you get a $50,000 line of credit, and so I can just take money, grab that money out of that line of credit to pay for renovations whenever I want. So I'm liquid. I have 50,000 money, that $50,000, 50,000 money, 50,000 that I can, in essence, borrow at any time, and I don't have to worry about my liquidity situation. But that
So it's essentially you're taking money out of, you're taking something out of, you're creating a hole, you're creating a vacuum somewhere else, though, isn't it? Isn't that what that means?
Yeah, the bank has, if I take $20,000 out, the bank needs to get its hands on that $20,000, and that's their job. So the banks are very good. Their job, they have to be very good at finding liquidity themselves so that they can provide liquidity to their customers. And so that's the thing. And so having the reserves is part of that. Because they have to make sure, oh, we have to keep this much money on deposit at the central bank. We're just going to make sure at the end of the day, there's a treasury team at the bank. They, by any means necessary, they make sure they have that amount of reserves in the bank. And how do they do that? They own, like, government bonds, private bonds. They borrow from other banks. They just make sure we can find the money before the money goes out. We find the replacement so that we hit our target. And what, let's say, Canada found, I think Australia, they abolished bankers. The United States also abolished the reserves, the reserve requirement. In Canada, until recently, because Bank of Canada basically forced them to, they held no reserves. The banks, at the end of the day, their target was to have a $0 balance at the Bank of Canada, and they basically hit it. Like, there were very small misses, but you have to there's like it's in the tens or hundreds of billions of dollars of transactions that these banks would have every day, and at the end of the day, they would always balance out and have zero balance. That's what the Treasury team is supposed to do, and they do it. And if things go wrong, they run to the central bank. That's the backup. This is the dreaded bank. If everything else, they're expected to find the cash in the private sector, but if they can't, they run to the central bank, and then the central bank has the ability to create reserves at will, and they will generally keep the bank from failing because the costs of the failure are too much. They're not going to be happy, but they will do it.
So
And
it's
so
like,
that's
so we're, sorry to interrupt you again, but it seems fairly precarious, a precarious setup. It seems to work because we only get these collapses from time to time. But and I do want to circle back to what is money. Dimitri's question again: what is money?
yeah.
But just on what you were talking about, like in my ignorance and in our ignorance, it seems quite a precarious set of rules or situations that exist there. Would that be accurate or not?
Yes and no. Like if you look at Canada, 1867, like the foundation of modern Canada, there were colonies before, but the Confederation was in 1867. Um, there were failures before then in the colonies, but since 1867, there's been no Schedule One bank failures. Or Schedule Ones are the big banks. There's like 5 or 6 maybe big banks. I mean, there's little small banks that have failed, but so like the big banks who dominate bank lending, none of them have failed since 1867. So I mean, yes, you can have crises, but it is also possible to avoid crises. Most of the time, there is no crisis, is the way of doing it. But eventually, the banking system will go over a cliff. The problem with banks, and there's a Keynes quote, which I'm not the for the bankers have discovered that they all do things in a herd, and it's sort of the safest, and they all go, oh, if they make a mistake, they all make the same mistake, so they can't be singled out. The
Okay.
dangerous thing in a bank is to be the only one making a mistake, because then you can be singled out and used as an example. And but if all the banks run to the central bank at the same time, well, oops, everyone made the same mistake. You can't punish them all, and so they can get away with it. So I mean, but that's the thing. So the system, there is an incentive that creates that everyone goes off the cliff at the same time, and regulators are supposed to stop that. But in 2008. I mean, it's just I can call it neoliberalism. There was the government need to step back from regulation, and they did, and they were excited. I mean, it generated maybe there was more dynamism. Things were going on, new financial products, but the thing was is the central bankers lost. They had no idea what was happening in the system. And it was a complete shock. They had no idea what was happening underneath the hood because they were too busy. They believe the stories of the financial system self-regulating. It's not completely self-regulating. And whoops, but they did learn a lesson. But the way these things work, now this is if you want to read Hyman Minsky is an economist, that they make a mistake, everyone pulls back from taking risk, and then things are nice and stable again. But then what will happen is, dum-de-dum, since everything is going smoothly, people start taking risks again. But since the system is stable, nothing goes wrong. Great. And so they just keep adding the risk more and more until finally, whoops, things blow up again. And that is the super cycle of capitalism. And that you have an economic cycle, but there's a long-term risk-taking cycle where people take more and more risk based on the fact that the previous risk taking succeeded, and we do more. And but the thing, it's not just banks; it's all the entire financial system.
Dimitri, do you want to come back in there? I suppose on the question of what is money then.
Yeah, I can get, well, basically the core, we've sort of covered it. The next layer of money, you have government money. The next, because you have very narrow measures, which is basically just government money. The next largest measure will include demand deposits at banks. So checking accounts. I don't know if anyone uses checks anymore, but accounts at banks, they're like not so that you can pull on demand. That is, you call it bank money, and that would be that you go from M0 to M1. They have different names, the measures, and that is it. And is usually there's far more the deposits are far larger than cash in most economies and banknotes, because most people don't need that much. It's generally only used like it's for small purchases and for the underground economy. That's sort of where cash tends to be used. So for law-abiding citizens, they don't really, not you don't go out buy cars with $100 bills and so forth. So you generally only keep a small amount of cash, and so most of your money would be in a bank account. It's more convenient. It's electronic, and so that's where most of like that measure. And then you get wider and wider versions of money where they're basically because the narrow measures didn't work the way the economists want them to, so they start throwing in more things used as short-term savings vehicles like money market funds and so forth. But that's the thing, that they're not used to pay for services, but they're used for short-term like what you could call cash in, let's say, in a portfolio. Normally you have an allocation, you say bonds, equities, and cash. And cash is stuff that holds value, gets just a little bit interest, but doesn't, you're not supposed to lose money on it, and it's stable. And then you allocate between that and bonds and equity. So the sort of cash portfolios started migrating. They're in the wider money measures. But for most discussions, it's sort of, there's the government money and there's the bank money, which lies on top of it. But as we discussed, the bank money, it's driven, its stability is driven by the government money. It's sitting on top. Functionally, it's on top of government money. It's more convenient for people to use. And see, the other thing about it, which people get very excited about, when a bank makes a loan to someone, effectively what happens is it creates deposits. People get very excited about this phrase. It appears out of thin air. There's a new, like if I go and say I want a loan from a bank, boom, my balance sheet expands. If it's $1,000 loan, I have a new liability. I have a loan to the bank of $1,000, but the
promise
bank
to pay.
I
I make a promise to pay, or whatever it is. I sign a contract.
Yeah,
and
you sign a
that creates the
contract.
money. Is that it?
Yeah, because they give me a deposit. They give me a deposit on they increase my deposit balance by $1,000, and that's it. So the deposit increased by 1,000, and I have a liability. For me, I didn't sort of get a profit out of this. Yes, I have $1,000 new asset, but I have $1,000 liability because I owe the money. I owe the bank money. I didn't.
This might sound like
banks.
This might sound like a super question, right? But it might be reasonable to ask. So, if I signed the contract and 1,000 other people like me signed contracts in order to get this amount of money, why is it not? Why? And they used. So, does the bank use that contract to secure a loan from somebody else? Then is that where it comes from?
Well,
And
no. I mean,
why is that not mine? Why do I have to owe it back to someone?
Well, I mean, it's just, it's all capitalist economy. A lot of the finance, it's all based on debts. Like it's driven by debts. Very little of it is driven by moving government money or gold or anything like that. It's not like people have a visualization that people stockpile little gold coins and move them around. That's sort of like Dungeons and Dragons. Or you walk around with sacks of gold coins. Like even like for example, the Romans didn't operate that way. They did everything. They had large transactions. They had large sacks of coins used to pay the soldiers, but but they didn't, for the internal, people didn't walk around with big bags of coins. So
So they
what
traded.
happens?
They trade
Yeah, and
other
yeah,
things.
yeah. But what's happening is if for the bank, what's happened is they've got the deposit. See, the problem that in discussions of banks, people look at it from the non-bank's point of view and say, "Wow, this money appeared out of nowhere." People are not used to thinking from the banker's perspective. There's not that many bankers out there, so it's not the sort of perspective you take. But if you want to understand banking, you have to look at it from the banker's point of view. The banker said, yes, they've written the loan, so they got this. They have a new asset, $1,000 loan, but let's say it's paid next year. So it's going to pay an interest, some rate of interest, which is hopefully attractive. So yay, if it gets paid back, they're going to get $1,000 plus interest. But they've got the liability. They, the deposits that I have at the bank is their liability. In essence, it's people don't like to think of the bank owes you money, but yes, it is something that it is a thing that I can take away on demand. It shows up as a liability on their balance sheet. So they grew their balance sheet, and see for them, for the bank, the problem is they just can't. If you have many banks, what the problem is that if I buy something from another bank, which is quite most likely going to happen, because a bank will, let's say there's 5 big banks, each has a 20% market share. So if I took that $1,000, the odds are there's an 80% chance I might go out and buy something from someone who banks with a different bank.
Mm.
So I send the instructions, send $1,000 to this other person, and that means my bank is instructed they have to send $1,000 to the other bank. So they've lost $1,000 cash.
Mm.
And you can think of it as if the banks operate with reserves, like there's a payment system's complicated, but you could think of it as the private banks, they have deposits at the central bank. How does Bank A send money to Bank B, $1,000 to Bank B? What they do is they send instruction to the central bank, remove $1,000 from my deposit at the central bank and move the $1,000 increase the deposit of Bank B. So they move the deposit on the balance sheet of the central bank.
Okay.
It is possible, like if I send $1,000 to my wife who banks at the same bank, the bank doesn't lose any, like it'll just move, like the liability just
Okay.
shifts through the deposit. But see, if it loses, and so it has to be ready. It has to be ready to replace that $1,000, which is why it's not a free lunch. Banks just can't go crazy and hand out an infinite number of loans without failing, because they will, they're going to get called on it. And so the regulations will force them to say, well, no, we have to limit our lending so that we can, money will vacate. Because if I'm a bank and I start increasing my loans, my customers are buying stuff and they're shipping money to other banks. Some will stay internal to the one bank, but most is going to go walkies to other banks. And so if I'm doing that and all the other banks aren't increasing their lending, I'm going to be losing deposits. But what happens in the real world is that all the banks are increasing loans, And they're also losing, but that means they're coming back, and some of that is coming back to me. So if all the banks expand at the same pace and everyone keeps their market share, they're basically gaining and losing the same amount. And so the whole system, what you see is that all the deposits grow, all the the loans by customers grows, but it's all growing together. And that's what happens. It's a private sector credit expansion, and this because it doesn't have to be bank loans. You see this with bonds and money markets. Firms issue bonds and or commercial short-dated loans would often be called commercial paper. What will happen is they borrow commercial paper, and then what will happen is that company will then recirculate the money. It'll say, well, it doesn't need the money necessarily immediately. It'll put the money right back into its own money market fund, and that money market fund will buy commercial paper from possibly the issuing firm or from other firms. So all private borrowing, everyone grows their balance sheets, and that's it. And it's not just banks; it's all borrowing. You create. There's a new contract. It's a contract. It's not. You don't need a lump of gold. You don't need government money. You just say, look, we're doing a contract. It's just a legal agreement. It can be done theoretically as much as you want. But it creates a new asset and a new liability, and it grows. And see, the problem is that works. The expansion works until it doesn't, when suddenly sooner or later you're going to get people who are too aggressive borrowing and they can't pay it back, and then the whole thing goes in reverse. And that's the tail. That's usually what happens at the end of a business cycle. It's the usual cause of a recession. The recent the COVID recession was different because the government said, no, we're just stopping activity. But that is, well, it's the only time I'm aware of, I can think of, where governments said we're going to stop economic activity. That is not usual behavior. The usual cause is the private sector saying, we can't do this anymore. Oops.
Yeah.
So
there's all of this to and fro going on. There's people taking stuff from here and putting it over here. And it's almost like a hierarchical setup whereby central bank is at the top. It's keeping the accounts of the banks, and the banks are managing the accounts of all the people. And the money, or what? It's not money. It's not fair to call it money, is it? It's like,
well, it's money, but it's the thing. I as an ex-mathematician trained, I'm very technical. The money is what people define as the money supply, and yes, it's bank, but there's other stuff that looks like money that's not in the money supply, which complicates things.
Okay, so it nearly is a case that it becomes money once it enters our hand, almost. I don't know. Maybe that's inaccurate.
Yeah. Well, it's just certain things are created money, and but they're debt. It's a debt instrument.
Okay.
So to a certain extent, so if we go to government money, it's what happens is it's sort of different, but what the usual state of affairs is, the economy grows, nominal GDP, which is sort of the measure of all the sort of the gross activity, productive, all the sort of productive activity in the economy, but it doesn't account sort of things that are just purely middlemen transactions. If you just swap money back and forth, it's sort of all the things that are being produced, and this equals the total income of everyone in the economy. So in nominal terms, you can do it. Usually people look at in real terms, but for government finance, we want to look at as nominal, because that's sort of the dollar amounts or euro amounts. What happens is over time the nominal GDP grows, and you see that people want to hold government bonds, and banks need to hold them because they're safe, and also government bills, as well as government deposits, but usually that's less. And so what happens is that people, what we see is that people have portfolios, and they want to keep a certain amount in government, government bonds, and that percentage is relatively stable as a percentage of GDP, which means that uh, if nominal GDP grows, you have to increase the amount of debt. They have to, and so what you see is the usual state of affairs is that governments will have small deficits. They spend more than they take in tax, and so uh, the net spending results in pushing government money into the banking system. And so that is sort of, that, and that's income that creates income, and that sort of, spending, and that helps stabilize private activity, because it's a new inflow of cash, and it's coming from the government. It's stable, and most sensible people in the developed countries don't worry about the government's defaulting. Euro area, it's a bit uglier, but like if you're looking at the United States, UK, Canada, where they have control of the currency, you don't worry about default, and so it provides an income flow, and that helps stabilize. That's what that is a major factor that stabilizes, because in a recession, less people are working, they're paying less tax, and you get more. I mean, the government may do stimulus measures, but they also will spend more just on welfare, transfer payments. And so what happens is the government has a larger deficit, and that means there's a corresponding push into the private sector. They're getting more money from the government, and that counteracts the negative effect of private sector businesses cutting back. So eventually things snap back. Like the recessions don't just spiral, causing the economy to go to zero. The government puts a floor in activity, and once the economy starts growing again, everyone in the private sector gets excited, and then the private sector gets back into gear, and then you're off to the races again. So the government. So that is the government provides a steady amount of push to the economy that helps keep the economy under control. And I guess if we sort of an MMT, see, technically the government will send
just hold fire for a second, right? So if I could summarize, well, first of all, Dimitri, does that answer your question?
Well, yeah, it was a pretty lengthy, but I have a couple of more questions.
Just sticking with the question, what is money? So in very short term and simple terms, we're saying, well, money is a lot of things, but primarily it's the to and fro or the transfer of debt between parties. Brian, is that really what we're saying?
Yeah, it's the measure. It's what you use to pay off debts, and so it acts as the account. And
it's a means of calculation of what I owe somebody else and what somebody else owes me, and it can be digital
and settled. Yeah, it's generally digital, but it could be
it could be notes,
but yeah, because I'd say you don't see debts. Well, I mean, theoretically you could, but you don't see, I'm going to give you 10 eggs, or like those sorts of, I mean, you can have such contracts, obviously, like suppliers, but in generally speaking, most like debts are done as, it's in monetary terms, and you do have to get something that the other side is willing to accept, and they have to accept money. It's possible you can pay off a debt by not giving them something that's technically not in the money supply, but it's a legal contract. If they say no, I don't like it, you can always they have to accept money. That's sort of that's what legal tender laws refer to. People sort of say that legal tender laws are not that you must use sort of government money to pay for things. And you can pay technically you can use whatever you want to pay for goods and services. The legal tender is, no, the debt has to be settled. You have to accept. Like you could use bank money, but at the end of the day, like because bank money ends up being considered equivalent legally, but you can't force someone to take something else that is, people might think of as being in the money supply, like a money market. No, it has to be a bank transfer or it has to be government money. So it's what you use to settle debts.
Okay. So, Dimitri, I'm going to come back to you in a second because you've got a couple other related questions. But I'm just conscious of time as well, and I want to get on to the MMT question. So, so this traditional kind of classical view of economics and the world and well, I suppose, first of all, it tried to assert classical economics. Correct me if this is, to any degree, this is incorrect. But classical economics seemed to suggest that this transfer and debt and financial arrangements between people can be quantified, and it's as simple as quantifying as mathematics would suggest. But there's something wrong with that idea. It seems to be more wiggly and uncertain than that. So that's the first thing. But then MMT comes along and says we don't have to worry about the government getting into debt or writing more government money. Is that right? That you can just continue to do that and not worry about the consequences. Is that accurate? Or suppose go back and tell us what is MMT in the simplest way you can, and why is it better than how we used to do things?
Yeah, what is MMT? It's sort of once again, that is a big question. I'm just going to step back because there's a lot of, I mean, what you see online, particularly from critics, is often fairly terrible. Like it's a deliberate misrepresentation about MMT, and it's all sort of a long history, but coming out of World War II, around World War II, you had Keynes's general theory, and that kicked off macroeconomics. And before then, macroeconomics wasn't a big, wasn't thought of in the same way. Keynes changed that, and
so what is macroeconomics? What does that mean?
Well, it's as opposed, rather than looking at how individuals, transactions, you're just looking at it from an aggregate, looking at the government as an aggregate actor, the business sector as an aggregate actor, household sector. So it's top down. You're looking at the whole system. You're not trying to infer what the system is doing based on what individuals are doing. And so that, and you had the post where you could see, like it's all kinds of Keynesians show up in this. So you had the old Keynesians, which was the mainstream.
So Keynesians being
they're not
followers and advocates for the theory of John Maynard Keynes, came around in about the 1930s. Some ideas about how the economy worked, right? So that's where that comes from.
But it sort of really caught on post World War II. It was like that, and so that was sort of the mainstream. But what happened is there was a split. You had what we would call the mainstream now, or maybe neoclassicals, if you want to sound academic-y, that's a word. And then you had the post-Keynesians, and the mainstream switched towards a mathematical framing, and it was supposed to be a mathematical science. The post-Keynesians switched to a more literary approach, and they attacked at the assumptions used in the model, because the models have to simplify things, and they attacked the assumptions of the neoclassicals. Up until maybe the 60s, the two sides talked to each other, but that broke down by the 1970s, and they split. And basically, the post-Keynesians went off in their own direction, and to be honest, completely ignored. They were ignored by the mainstream. They less so in Europe, post-Keynes, but in North America, they disappeared like almost completely from sight. Like the only one you maybe heard of was Minsky. In North America, they totally disappeared. This is less true in Europe. But that's, as someone from a North America background.
What did these guys advocate?
What?
what did the post Keynesians, what did they advocate? Was they the precursor to MMT?
Well, yes, that's it. The post-Keynesians, they were general. I mean, basically a more left wing. The mainstream, you could say, was right, more sort of free market, but there is a difference. You could say what you would call neoliberal, which is sort of technocrat. I mean, I don't want to go too far in neoliberal. That there was a centrist sort of technocratic solution. Yay for capitalism that can solve problems. That was sort of within, generally mainstream, but there is a split. It's not just sort of pure right wing, pure free market economics, but the post Keynesians tend to be generally more left wing. But so MMT, the problem with the post Keynesians is they split into a lot of factions, and they were not hugely influential. And MMT, there was a sort of small group of scholars who had some, there were new ideas, but they fit within the post-Keynesian tradition. So it's not all radically new. They were post-Keynesians, but they did, in essence, they formed a school of thought, and there's like a dozen schools of thought within post-Keynesians. They had particular views, some of which about floating exchange rates, where they disagreed with other post-Keynesians. But what the MMTers did was that they decided to reach out, and instead of writing papers aimed at just other post-Keynesian, it'd only be read by other post-Keynesian academics, they went for a wider appeal. And that is the thing. And to a certain extent, they gave their grouping the snappy name of modern monetary theory, which is a little bit of an in joke, because it comes from a Keynes saying, well, modern money being around for 4,000 years. It's a long say that it's been credit based. It's a sort of a very obscure. It's an obscure in joke, but to a certain extent, it's new. The approach was largely new. Like there's some new theory, but it mainly fit within existing post Keynesian ideas, along with some new things that set it apart. But but the thing, what made it different was targeting. Not, I mean, there was a outreach to sort of non-economists. I would have been in sort of the early, because one of the founders of MMT was Warren Mosler. There's, you could say, Bill Mitchell, Warren. They independently came up with sort of the same ideas about the job guarantee, and so Warren Mosler, a wealthy investor, he made money trading government bonds. He had a firm that we dealt with. And so that's how I got introduced to his ideas. I mean, and so and it very much okay. So there was actually, there's quite a few people in fixed income markets who were aware of the idea. But then what happened was with blogs, Bill Mitchell had a blog, one of the early economics blogs, that helped sort of see there was like a large online community, got wider. So it reached out beyond academia and people like in the financial markets like myself, and it reached a wider audience. And it, for them, it was right, because for people outside, this is all radically new.
What is the basic premise of MMT? I know it can be a complex area or whatever, but what does it advocate?
It's the core, like sort of a lot of the core comes out, what is the freedom created by having a floating currency? And one of Warren Mosler's earlier books is called Soft Currency Economics. And a lot of modeling, all the classical assumptions dates back to sort of a Bretton Woods era, where currencies are linked to gold, or directly or indirectly. Like Bretton Woods
tangible,
was
real.
Yeah, they linked to the U.S. dollar. The U.S. dollar was linked to gold, but when when the U.S. broke the link to gold, and because everyone pegged, once the pegs to the U.S. dollar fell, basically you have the modern fiat currencies, which was actually relatively unusual. And so how does that change policy? And so that is sort of the core, and what are the could do with it? And part of the sort of one of the insights, which is that, look, rather than what determines the value of a currency? Like, why is this coffee $2 and not $20? Right? That it's actually, from a theoretical point of view, it's not clear why. In the real
It's just
world,
historical. Then I'd imagine if it was
it's
$2
historically,
last 6 months ago, it's
because
$2.20 today.
yeah, and see, it comes down to, yes, I mean, because everyone, well, you'd say, well, this is what it takes to make a profit, and see, everyone is locked in. Everyone is locked in costs. Like, you have wage contracts, and so to a certain extent, the fact that it's $2 or $2.20 now, including tax, that's driven by the profit and their costs, and so they don't really have a choice. It's got to be that if they want to make money. And the wages, well, this is what the wages are. So, but it's not like, within an economic model, it's very hard to measure all these little contracts that block in the past history. And so the MMT argument, like, this is sort of a very idealized situation. What you can say is, look, the one of the most important prices in an economy is wages. You don't sort of think of wages being a price, because most people aren't capitalists, but the wage is the price of labor. And so what you can do is, you can say, why not try to lock down the price of labor, and not completely, not through like a wage and price control, but rather, we're going to say, the government is going to say, we're going to give a job guarantee. If you're not employed, you can go to the government and they guarantee that you will have a job at a certain wage. And this then becomes the de facto minimum wage of the true minimum wage, because you're always going to get it. You have minimum wage laws, but the label's a bit misleading, because you only get that wage if you're employed. Here, the government is saying, we're going to take in everybody. We're going to pay you how many dollars an hour, and that's it. And so the private sector says, well, we have to offer a higher wage. And so what you get is, the private sector is going to have to set their wages off what the job guaranteed wage is.
Okay.
And so then what will happen is that the private sector wages start becoming a function. Like, they're not, like, it's going to depend. Like, if things are going well in the private sector, they might be willing to bid a higher premium over the job guarantee. So, like, it's not like the private sector wages are going to be fixed forever. They'll move around with the economy, but it sort of provides a base. They can prevent wages from falling, which is relatively rare. Wages won't fall under that system, because they're not going to drop below. I mean, they could fall if they're high enough away from job guarantee. They're not going to fall below the job guarantee wage. But there's limited abilities to stop it from rising. Because if things are going well in the private sector, everyone will say, I want a private sector job. And, the economy overheats. And that's the thing. So you will get the rising wages. So how you stop the inflation beyond, like, the rising wages, which then feeds into the cost of the things you buy. How you stop that is, you have to withdraw spending power from the economy, and you do that through taxes. And so inflation, the thing that, going the other way, you use taxes on nominal activity. So income taxes, value added tax. As you get more nominal activity in the economy, people pay more taxes, and that will reduce the exuberance of the private sector, and so it'll stop overheating, and then hopefully you get nice steady growth without excessive inflation.
That's kind of wishful thinking, I think, isn't it? Because So the idea with MMT then, if I understand it, is that the government has the ability, as long as it has control over its currency, to create more currency, to create more money, to pay for these essential services in society, and that, am I right in saying this? That people don't have to
Yeah,
be in
yeah.
destitute, and
The
the
government
country doesn't
can't
need
run
to
on
suffer,
money.
so to speak.
Oh, okay, I didn't hear your last part, but the government won't run out of money. But the problem is, and we've seen this in, like, it was less of an issue in the 2010s, but the post-COVID recession. The problem is that they can only buy things that are available. And if the government is buying up too much things, there's less available in the private sector, and you get inflation. And so that is sort of the limit. It's not simple. It's
Okay.
not like it's not a simple relation. And some people will oversimplify. Like it's it's not easy to guess. And
Okay. So slight interruption to the video there. So you were talking about MMT, government having control over its own currency and injecting, let's call it cash for want of a better word, into the economy to keep things moving and pay for essential services and so on. But what happens if the okay, so you're talking about devaluing the currency by doing that. That's the first thing. And you could end up bankrupting the government, or you could end up like Argentina or any other country you want to name that's gone into a lot of difficulty. People are out of work and so forth. Is that a valid argument, Brian?
yeah, I mean, the worry is, like, Argentina. See, they don't control their currency. I'm not an expert. I generally avoid emerging market, but they don't control the currency, and so they run into problems. The euro area is it's a floating currency in the sense it can be created. It's not pegged, like the euro isn't pegged to the US dollar, which would put a very hard constraint on it. The problem is there are sort of internal constraints, as countries like Ireland found out. But in theory, a sensible central bank, if you could find one, could deal with these issues. There's a design problem with the euro, but in general, see, the limitation on policy. This is a lot of MMT debates. There's some oversimplification. It comes down to people sort of misinterpret or exaggerate. They don't you don't The government doesn't need to worry about the dollar amounts, like whether the deficit is, like, the dollar amounts aren't really the concern. That's not the real problem. Whether deficit is 10 billion or 20 billion, by itself, the dollar amount isn't that meaningless. What's meaningful is, what are the real resources? And if you start running out of real resources, you start hitting inflation constraints. Inflation will happen, and that's the thing that limits
Okay.
policy.
Yeah.
They can't. You just, like, in theory, yes, the government could hand out, the Canadian government, if they wanted to, with they might have to make procedural changes. They could hand out $1 million to every Canadian citizen. They could do that, and you'd have a very serious inflation. And that's really the problem. I mean, they probably would go bankrupt if they tried it, because there are rules that would stop it. Like, they would have to finesse things. But in general speaking, there's no reason the government is going to default where it's got control of the currency.
Okay.
And it could just say, yeah, we can fudge this, but what it can't fudge is the availability of real resources and inflation. So that is the
So
thing. And
building
that and but
materials to build the roads, the labor in
yeah,
order to put the
yeah,
building materials together,
yeah,
the nurses, the doctors, the whatever
yeah,
else to provide the service. If that's not there, prices go through
yeah.
the roof, and we have a big problem.
Yeah, and it's tougher if you're importing. That is a separate, like, if you're importing a lot of critical things, then suddenly you're dependent on importers. So then you have an added constraint. But by and large, which is a big sort of debate between MMTers and other post-Keynesians, but that's still it's a bit of a niche argument, but it's part of the problem. But yeah, so that's it. Like it's
Mm.
and it's in some ways, if you look at the mainstream, uh, sort of discovered this the hard way. Like this was a big debate in the 2010s, and sort of the mainstream was horribly wrong. And to a certain extent, the debate has died down, at least among serious commentators. Like they haven't completely learned. Like they still will express. They're always looking at dollar amounts. Like they're worried about the debt. But to a certain extent, the debate has died down because there's an element of, well, okay, we sort of agree. They being pushed to say what they were saying was stupid, and they sort of realized it was stupid and wrong, and rather they don't admit defeat, but they sort of stop that argument. They sort of so in some ways it's a bit less like the insights are a bit less radical than it was in the 2010s. But to be fair, within financial market commentary, no, it's still somewhat radical because a lot of the people are sort of have very simplistic and, sort of anti-government stances, and so they still believe a lot of silly stuff, but that's not really there's no good academic backing. But they're there. These are the people you run into online. But the thing is that people say a lot of crazy stuff online, and so it's a bit futile arguing with them.
Okay, so perhaps it's a model that would be adopted, but I think in the universities around the globe, it's still very much about classical economics and trying to get a grip of this aspect of human behavior, because that's what it is, really, isn't it? Playing out in markets and exchange and finance and all the rest of it. But
Yeah.
Dimitri, you have a couple other questions for Brian there you want to come in on.
Yeah, well, it's just already probably too late for that. I should have asked them in the beginning. But anyways, I just wondering who regulates the amount of money central bank issues in the system, actually. So is it the government who gives them the permission to issue, let's say, I don't know, certain amount of cash, a certain amount of virtual currency in order to, well, for circulating in the system?
Yeah. Well,
So
I mean, the
is this
central
the money?
bank.
Is this the money? Is this what you're talking? This is the money that you and I get paid for work, Dimitri. Is that what you mean?
Well, yeah, I mean, the whole situation, as far as, would it be correct to say that this whole public debt, the government debt, is basically the amount of money circulating in the system and the central bank issues on behalf of the
Huh?
government, or not?
Yeah, yeah. Well, that's the thing. You have to government debt. Although I mean, some people want to include government debt as being money. You could sort of try to argue that some MMTers, if you did like. But they aren't like technically no, they're not considered money, and they don't. Yeah, they're not that money like. They're sitting in it's a long-term investment. You don't use them. But although that's a little bit, you can actually borrow against them quite easily, so they end up looking a bit money-like. But they don't keep their value goes up and down a lot, so they don't fit the definition of money. But yes, if you look at government, because government, the central government liabilities. And that's one thing. When I'm talking about governments, I'm talking about sort of central governments and not the subnational governments, which are important and are different. But for the national level, you have liabilities. You will have the government money that ends up, because they own the government, central government owns a central bank. So the central government's liabilities are really when you consolidate them, it's part of the overall government. If you look at the overall government, the private sector has some government money and they have some government debt. And those are their the amount of their liabilities is determined by the deficit. And that's just the government would like to control that, but in practice, they don't really control it. It's driven by economic factors. They'll have a target for the deficit, but whether they hit it or not is luck. It depends on, they have to get, if they forecast the economy correctly, they might hit their deficit forecast. But if the economy evolves differently, so the total amount of government liabilities in the system is driven by fiscal policy. The deficit, because that's the change. The deficit means, that they're putting more liabilities into the system than they're taking out. So that is not really, and it's not completely controlled. But what the central bank can do is they can influence whether people hold money or bonds. Are the liabilities money or bonds? But the thing is, they can do that, but it doesn't really have much of an impact, because what's happening is it doesn't really affect the economy if a because it works through the banking system, and basically it doesn't really matter whether banks hold government bonds or government deposit the central bank. It doesn't change their behavior. Like people thought it would, but it doesn't. I mean, what matters for the private sector is the willingness of people to borrow, and that's not driven. It's not driven by the reserves in the system. It's driven by the willingness of people to borrow and the willingness of people to lend to those people, and so that's the thing. So it doesn't. It the like the government deficit is an income flow. So that matters to the economy. But how you split between money, government debt, it's less important. And what the other thing that really matters for the economy is the willingness of the private sector to borrow, and that will show up. If you borrow more, you will create private sector money instruments like
So you're
bank
really
loans.
so what we're really talking about is managing expectations and perceptions of how safe it is to do that borrowing. Because if I perceive the economy not to be in a good place, I'm not going to borrow that 50 grand to do up
Yeah.
my house, or I might be concerned about my job a little bit. I'm not too sure. So maybe what we're talking about, when you see, let's say, European Central Bank or the Federal Reserve in the US or whatever it happens to be, they're merely is it simply that they're trying to manage expectations? Is that their primary concern?
Yes, it's not just expectations. I mean, there's actual orders. I mean, people get new jobs. They have the job, and they're maybe more willing to buy a house, or businesses see orders coming in, they're going to invest, and they're going to hire people based on this. But the expectations will matter. They really show up like in a recession, where people fall back, even though orders may not have fallen yet. They think they are, so people cut back. So, the expectation management is important. This is why, for example, central bankers will they will never forecast a recession publicly. Sometimes they don't even use the recession. They won't use the word at all. They don't want to spook people, because if the central bank says, "Oh, we think there's going to be a recession," that will cause a recession, because everyone will panic.
Self-fulfilling
And so,
prophecy. Yeah.
yeah, it's a self-fulfilling prophecy. So the government, the central bank, always is predicting that things are going to work out well, on in terms of a recession. So but but generally speaking, it's a combination of what people think is going to happen. Most of the time, people don't pay attention. Like they're looking at what's actually happening. So it's not purely oh no, like, in the markets, yes, expectations are very important, but people in the real world most of the time don't care. They see what's actually happening. Hey, I got a raise at work. I got customers coming in, and they base it off that,
Yeah.
and they're not paying. It's only in a panic that people actually start paying attention.
Yeah, and then it's too late. But then there seems to be something going on behind that surface, behind that kind of facade of everyday activity, that all of a sudden, you mentioned it before, this kind of business cycle whereby larger organizations take increasing risks until it pops. And I think that's where what we're talking about here, the rubber meets the road for ordinary people, and what they need to understand, or what we'd like to understand about how all this works. We try and keep it simple for ourselves, but maybe it's not so simple.
Well, I mean, the business cycle is complicated. I mean, and everyone disagrees. Like if everyone agreed making money in finance would be easy, and it's not. It's not easy being right about the direction of the economy. I mean, central banks, sometimes they're good, sometimes their forecasts are bad. Um, Usually forecasts work well when everything is growing steadily, and then you just things continue the way they were. That happens a lot, but it's hard to predict. Like when I actually do have a thing on recession, a book on recessions, and yes, recessions are hard to forecast, but uh, you know, that's the I guess if you want to sort of get back to MMT, the issue is, should the government be, it should be thinking like a household. It should be worrying about, are
Yeah.
people employed, and it should be worrying about, the real activity in the economy, and the debt will take care of it. Generally speaking, the debt will take care of itself.
Eventually,
That's
eventually,
Yeah, eventually, yeah. Eventually, if the in the worst case, people, if they're too rich, they start spending more, the economy will boom, you will get a little bit of inflation, and they get higher nominal GDP, and then the ratio drops. So that's, it eventually takes, like, it's not a question of running out of money. Once again, euro area, it's,
an
they do
exception.
have they have to sort of play by the rules set by the ECB. They relax things a bit. I'm not really, uh, uh, you know, things are more relaxed and hopefully better. The last time I really paid attention to the euro area was during the crisis, the early 2010s, and things were very ugly. But
Mhm.
things are a little bit, they've gotten a bit more sensible since then. But but yeah, so I guess that's sort of like the political takeaway, that, don't think of the government as being like a household or a business. It has other part. The government just should focus on keeping people employed,
Yeah.
and other things will sort themselves out. I
Yeah.
mean, inflation does matter, yes, but because people don't like it, as people discovered, inflation is toxic politically, so they do have to worry about inflation.
Yeah, I wonder, Dimitri, and you and I have spoken about this before, how much inflation is due to, um, let's use nice words, maybe a certain overexuberance on the part of corporations to extract more profit out of the transaction. And maybe that's the problem. And it's not necessarily the fact that people are working, or that maybe someone's received a 2% pay rise this year or last year, whatever, and that it's this
Well,
excessive
yeah,
profits that's the cause.
yeah, that's been a big debate. I mean, the profits aren't a large enough part, and in most cases. In a few cases, you have excessive price gouging, but it's only a few firms that can actually get away with very high excessive price grabs. In most cases, you have competitors. You're limited. Like, even if you increase the profits, it's still a relatively small part of the total price. The
Mm.
expenses are a big, and so it's a combination of both. I mean, there certainly was a certain amount of taking advantage of the situation, but at the same time, there were, certainly there was strong wage growth, and so that it's not just one thing that caused it, and you can only sustain the profit expansion so far. If wages don't keep up, if you raise the price and wages don't, then you can buy a smaller volume, and a smaller volume implies a recession. And so I mean, it's possible you could say, well, if you had better antitrust, it could have reduced the high spike of inflation. But we're back to sort of our normal, like it's around 2% here, just over between 2 and 3, and I'm not sure Ireland, but in the United States. So it's back to sort of a more normal level, and it's a combination of profits, and like profits can only expand so far as a percentage, and the input costs are going up as well. So at this level, you do need the economy. You do need growth in the economy to be able to sustain the inflation.
Yeah, and the interest rates have come back a small bit on this side of the water, so that's a good thing for people at work and people in households and the rest of it. Dimitri, have you anything else to add or queries for Brian there before we wrap it up?
No, I don't think so. I think I asked already everything I wanted to.
Yeah. So, in summary, the economists will continue to debate the relevance of MMT or any other particular theory that's to be applied in the markets and the economy and so forth. And you and I will really have no say in that. I suppose that's fair to say, Brian, isn't it?
Well, yeah, I mean, the economists debate, but to be honest, the economists debate, the politicians haven't necessarily been listening to the economists. I mean, like at the central bank, yes, but in terms of fiscal policy, there is actually a certain amount of flexibility. I mean, whether MMTers, like no one, no one's going to admit that they're agreeing with MMTers. I mean, maybe some will, but in general, it's sort of it's tribal politics. You need to understand that you need it's anthropology. You need to understand
anthropology or economic anthropology.
Yeah. Yeah, how it's reacted. They're a bit of an out group, but I mean, some of the debates have died down, and there's sort of an agreement, but no one's going to admit there's agreement. But there are core disagreements, like the theoretical disagreements aren't going to go away, but to a certain extent, it's like if you're not studying economics 101, it's less relevant in terms of what's actual policy debates. There's maybe less of a difference, and a lot of the debates are on areas that weren't really MMT versus classical. There's it's less, the dividing lines are different places. So whatever, but it'll show up like what you see online. It's going to probably continue. It's sort of, but that's the thing. It's sort of a frozen debate between MMTers and usually sort of more free market evangelists, and though it's sort of ideological debates. Those aren't going to go away anytime soon, and they're not going to change. They're very predictable. The same arguments over and over. 20 years, you'll probably see the same ones happen.
Yeah. So people's everyday needs and so on will still be primary for them. They'll still need to get up, go to work, earn a few bob. They'll still need to get the loan from the bank. It's to do up the kitchen or whatever happens to be, and that stuff goes on. I suppose it ebbs and it flows, and we've greater access to. It becomes easier maybe this year, maybe not so easy next year. I suppose working people will still have to get up and do what they have to do, and try to release the kind of constraints around their own ability to earn and make a living. And if you look at certain papers and research and so forth, and we see that maybe people's real take-home earnings have reduced in the last maybe 20 years, and maybe we need to rectify that, but we'll see. Okay, Brian, great to talk to you, and an enlightening conversation. If it hasn't raised even more questions for me, and I suppose Dimitri, you as well, hopefully it's answered a few. I appreciate you taking the time. Folks, if you want to read more about Brian's work or access his material, it's bondeconomics.com. Here's a copy of one of his recent publications. He's a bunch more on them coming out. So we'll include links below wherever you get your podcasts and wherever you happen to be watching this. So thanks a million, Brian, for your time today.
Okay.
Thank you.
Okay. Thanks.
Okay,
Yeah, thanks,
folks, this has been Sunday Letters. You'll get us at sundayletters.substack.com. And we go out on a regular basis on podcasts and also on the newsletter. You can support what we're doing. If you like this material, you can support us by being a paid subscriber, and you can indeed access this material for free. You can buy some merchandise. There's links below as well. And also, if you feel so inclined, you can sponsor the show on a once-off basis. Again, there's a link below. So until next time, we'll see you around. All the best.